Hey guys, it's Mr. Schmidt here, and in this video we're going to get into the nitty-gritty here of Unit 15 and look at something called fractional reserve banking. So we're now going to really dive into how the banking system works. We hinted at it a little bit in Unit 14 with the financial sector, but we're going to really start talking about how banks actually work. So this idea of fractional reserve banking, so what does that mean? So this is the idea that when banks hold a portion of deposits to cover potential withdrawals and then loan the rest of the money out. So for example, if you have a person, we'll call him Bob, and Bob deposits $1,000 into our bank. You might think, well, gosh, if the bank has this $1,000, why don't they just loan out the $1,000, right? Well, they're aware that Bob and other depositors may want their money back at some point. And the worst thing a bank can do is not have money on hand when people come in and want their money, right? There's that old commercial, it's my money and I need it now, right? So you don't want people starting their own series of commercials because your bank isn't doing its job. And this can be pretty disastrous for banks that aren't good at fractional reserve banking. In the past, there used to be a lot of these things called bank runs, where a bunch of people would lose confidence in their bank, and a bunch of them would rush into their bank to grab their money. And because everyone was doing this, and the bank was like, we lent out the money, that was not a good situation. And so what the government started forcing banks to do is this what's called fractional reserve banking. In other words, hey banks, we know you make money by lending money and charging interest, and we know you want to do that, but let's force you to hold a little bit back in reserve so when people come to withdraw some of their money, maybe Bob only comes back and wants to just withdraw, $100 of what he deposited, you're able to meet those requirements, right? You're able to meet Bob's demand here to get some of his money out of his account. That requirement, we call that the reserve requirement, okay? It's the percent of deposits banks must keep in reserve at the bank and not lend out, right? So for example, you could have a reserve requirement of 0.1 or 10%. So what does that mean? Well, this means that if Bob here deposits $1,000, $100 of that has to go in what's called, and we'll talk about this in a later video, required reserves, which I'm going to call RR. And so the bank has to keep that $100 in the bank. They can't touch it. They can't lend it out. It's got to stay there. But the other $900 of that deposit, they could lend out, charge interest, make money off the $900. It doesn't mean the bank has to lend out the entire $900. They could still choose to keep some of that money in reserve, in what we call excess reserve. We'll talk about that in another video. But the point is, by forcing banks to keep a part of their deposits that are in their bank in reserve, it helps them avoid the disastrous consequences of bank runs, where people are rushing the bank, wanting their money because they've lost confidence in the bank, right? So this helps banks meet the demands of their customers, right? Because Bob, is basically saying, hey, if I want my $1,000, you better have that on hand. And so by taking a little bit out of every deposit and keeping that on hand, the company, the bank, can meet Bob's request to get money out of his account. The reserve requirement is so very important for you to understand, okay? It is the percent of deposits banks must keep in reserve. Now, you'll often see it written as a decimal, so 0.1, or as a percent, 10%. And you'll see in the next video that we're actually going to want it as a fraction too from time to time. But that is the idea of the reserve requirement. So fractional reserve banking, we're going to keep a fraction, a portion of deposits at the bank in reserve, don't lend it out, so that when depositors want their money, the money is there to be withdrawn. And that requirement is called the reserve requirement decimal, or percent. That's all for this video on fractional reserve banking. Until next time, have a great day.